Introduction. Food and Beverage is a prominent company listed on Bursa Malaysia, the stock exchange of Malaysia. The company operates within the food and beverage industry, providing a diverse range of product and service to consumers. With a presence in Bursa Malaysia, Food and Beverage has established itself as a key player, delivering quality offering and contributing to the growth and development of the Malaysian market. Through its strong market presence and commitment to excellence, the company has garnered the attention of investors and consumers alike, making it a notable entity within the dynamic landscape of Bursa Malaysia. Company review. So this is a company review. A company are we selected. Number one is Hapseng Industri Berhad. Is a leading Malaysian biscuit manufacturer known for its wide range of high-quality products. With a focus on taste and quality, the company has built a strong reputation in the industry. It operates modern manufacturing facilities and a robust distribution network to reach a broad customer base. Additionally, Hapseng has diversified its operation into property investment and development. As a publicly listed company, it upholds strong corporate governance practice and aims to provide value to shareholders and stakeholders. Overall, Hapseng Industri Berhad is a well-established company that continues to pursue growth opportunity while meeting consumer demands. Number two is Dutch Lady Make Industri Berhad is a leading dairy company in Malaysia. Established in 1963, the company specialized in the production and distribution of a wide range of dairy products, including milk, yogurts, and infant formula. Dutch Lady is known for its commitment to quality, nutrition, and sustainable practice. The company operates modern manufacturing facilities and has established a strong presence in both domestic and international market. With a focus on innovation and meeting consumer needs, Dutch Lady continues to be a trusted and preferred choice for dairy products in Malaysia. Number three is Fraser and Neave, or we known as FNN's Holding Berhad, is a prominent Malaysian beverage company. Founded in 1883, the company has diversified portfolio of beverage, including carbonate, soft drink, isotonic drink, dairy product, and juice. FNN is well known for its popular brand such as 100 Plus, FNN Funflower, and FNN Magnolia. The company operates modern manufacturing facility and has a wide distribution network that reach both local and international market. FNN is committed to delivering high-quality product, and it recognized for its innovation, sustainability efforts, and commitment to consumer certification. As a leading player in the beverage industry, FNN continues to drive growth and maintain its position as a trusted and preferred choice for refreshing beverage in Malaysia. Next is Spritzer Berhad, a Malaysian beverage company specialized in producing and distributing bottled natural mineral water. Founded in 1993, the company sources its water from protected aquifer in a pristine rainforest. Ensuring purity and freshness, Spritzer offers a range of bottled water products, including still and sparkling varieties, catering to domestic and international market. With state-of-the-art facilities and strict quality control measures, Spritzer has earned certification for product quality and safety. The company has expanded its product portfolio to include carbonate soft drink, fruit juice, and other beverage. As a leader in the bottled water industry, Spritzer continues to uphold its reputation for excellence and environmental stewardship. And the last one is Powerroot Berhad. Powerroot Berhad is a Malaysian beverage company known for its instant coffee and tea product under the brand Ahwat and Ali Cafe. With a strong domestic and international presence, the company emphasized product innovation, quality and effective marketing strategies. Powerroot has invested in modern production facilities, maintained strict quality control, and has expanded into retail and distribution service. Committed to sustainability and corporate social responsibility (CSR), Powerroot's aim for growth while delivering high-quality beverage to a diverse consumer base. So, we have selected 5 companies that have significant personal meaning for us. These companies have been part of our life since childhood and continue to thrive in the Malaysian stock market today. It is interesting to witness their continued presence and success over time. Our presentation will showcase their rich history, innovative approach, commitment to quality, and ability to adapt to changing market dynamics. We invite you to join us on this nostalgia trip and celebrate the incredible stories behind this company. What is liquidity ratio? Liquidity ratio is a financial metric that assesses company ability to meet its short-term obligation using its available liquid asset. It provides insight into a company liquidity position and its ability to cover immediate financial needs. The two commonly used liquidity ratios are current ratio and quick ratio. These ratios are important for investor, creditor, and analysts to assess company liquidity position and its ability to handle financial challenge in the short term. However, it's important to note that the ideal liquidity ratio varies across industry, and it's crucial to compare company liquidity ratio with industry benchmark and historical trends to gain a comprehensive understanding of its financial health. What is current ratio? Current ratio, it is calculated by dividing current asset by current liabilities. The current ratio measures the company ability to pay off its short-term liability with its short-term asset. A higher current ratio indicates better liquidity and the ability to meet obligation. Let's analyze the current ratio trend for Spritzer, Powerroot, Hapsang, FNN, and Dutch Lady over the years 2019, 2020, and 2021. In 2019, Spritzer had a current ratio of 3.15, Powerroot had 2.22, Hapsang had 1.96, FNN had 2.21, and Dutch Lady had 1.08. Moving to 2020, Spritzer's current ratio increased to 3.49, Powerroot to 2.39, Hapsang to 1.80, FNN to 2.42, and Dutch Lady declined to 0.89. Finally, in 2021, Spritzer current ratio was 3.17, Powerroot was 2.86, Hapsang improved to 2.09, FNN increased to 2.69, and Dutch Lady rose to 1.58. Spritzer maintained a consistently high current ratio above 3 throughout the 3 years, indicating its strong ability to cover short-term liability. Powerroot exhibit a steady increase in current ratio, reflecting improved liquidity management. Hapsang show a slight fluctuation in its current ratio, but overall remain above 1, suggesting a reasonable ability to cover short-term obligation. FNN demonstrate a relatively stable current ratio within a range of 2 to 2.7, indicating adequate liquidity. Dutch Lady had lower current ratio compared to the others company, but show improvement over the years. What is quick ratio? Quick ratio, also known as acid test ratio. It is calculated by subtracting inventories from current asset and dividing the result by current liabilities. The quick ratio provides a more stringent measure of liquidity by excluding inventory, which may not be easily converted into cash in the short term. A higher quick ratio indicates a strong ability to meet short-term obligation. So let we analyze the quick ratio for this company. In 2019, Spritzer had a quick ratio of 2.45, Powerroot had 1.49, Hapseng had 1.64, FNN had 1.48, and Dutch Lady had 0.61. Moving to 2020, Spritzer quick ratio increased to 2.95, Powerroot to 1.86, Hapseng decreased to 1.43, FNN slightly increased to 1.51, and Dutch Lady declined to 0.42. For Spritzer, showcase the highest and most consistent quick ratio, indicating a strong liquidity position, and the Powerroot demonstrates steady improvement in liquidity over the years. Hapseng experienced fluctuation but managed to recover in 2021. FNN maintained stable quick ratio within an acceptable range. And the last one is Dutch Lady, had a lower quick ratio, indicating a comparatively lower liquidity level.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Abdul Khalid bin Muhammad Fauzi. I will continue this presentation. It's about profitability ratio. What is the profitability ratio? These are the financial metrics that assess a company's ability to generate profits and manage its expenses relative to its revenue and other measures. These ratios provide insight into a company's overall profitability and its efficiency in generating return for its stakeholders. Some common profitability ratios include gross profit margin, net profit margin, return on asset, and return on equity. These ratios help investors analyze and stakeholders evaluate the company profitability, efficiency, and overall financial performance. It is important to compare profitability ratios with industry benchmark and historical data to gain a comprehensive understanding of a company profitability and its relative performance in the market. Let's continue with the net profit ratio. What is net profit ratio? Net profit ratio is a net profit divided revenue times 100. It is calculated by dividing net profit by revenue and multiplying by 100. The net profit margin represents the percentage of revenue that remains as net profit after deducting all the expenses including taxes and interest. A higher net profit margin indicates a better overall profitability of efficiency in managing expenses. As we can see the graph on the slide, between the 3 years for the 5 company, they have not much different. But for the Dutch Lady, 2021 is gain more net profit ratio. As we can see, in 2019 it's only 9.65. In 2020 it's a 6.67%, but in 2021 is getting more until 21.87%. It is a big gain for net profit ratio for this company. So that's all for today. Next, I focus on measure called return on assets (ROA) for the years 2019, 2020, and 2021. Let's start with Spritzer. A well-known bottled water brand, Spritzer ROA numbers changed a bit over 3 years. In 2019, the ROA was 6.26%, showing how well they used their assets to make a profit. In 2020, it improved to 6.90%, meaning they became more efficient and using their resources. However, in 2021, their ROA dropped to 4.34%, suggesting a decrease in profitability compared to their asset. Next, we have a Power Root, a company that makes beverages. The ROA figures show more significant changes. In 2019, Power Root's ROA was 8.47%, indicating they generated a good profit from their assets. The following year, in 2020, it rose to an impressive 13.74%, showing they became even more efficient. But in 2021, their ROA went down to 8.13%, suggesting they weren't as effective in utilizing their issues. Now, let's talk about Hapseng, a famous biscuit manufacturer. Hapseng consistently performed well in terms of ROA. In 2019, the ROA was 17.73%, meaning they made a substantial profits compared to their assets. In 2020, it remained steady at 17.65%, showing their continued efficiency. However, in 2021, the ROA slightly dropped to 13.15%, but it was still quite good compared to other companies. Moving on to FNN, a well-known company in the food and beverage industry. FNN had relatively stable ROA numbers. In 2019, the ROA was 11.71%, indicating they used their asset quite efficiently. It slightly decreased to 11.65% in 2020. In 2021, the ROA was 10.88%, which was still a decent performance in terms of asset management. Lastly, we have a Dutch Lady, a popular dairy company. Dutch Lady showed remarkable ROA figures during this year. In 2019, the ROA was an impressive 23.21%, demonstrating that their exceptional ability to generate profit from their assets. However, in 2020, it dropped to 14.72%, suggesting a temporary decline in efficiency. But in 2021, they make a strong comeback with an impressive ROA of 35.37%, indicating a significant improvement in asset utilization. To sum it up, this company had varying ROA performances. Some experienced change or slight decrease, while others maintain consistent of outstanding return on their assets. Remember, ROA is just a one measure, and the other factors to consider when assessing a company financial health. Thank you for listening, and I hope this discussion provided you with a better understanding of this company's financial performance.
Assalamualaikum. My name is Ella Nofitri binti Yunus. My student ID is 2022966343. Okay, for my part, I will present about leverage, debt ratio, and debt to equity. Okay, leverage ratio refers to a group of financial metrics that assess the level of debt or financial leverage used by a company to finance its operation and investment. Okay, this ratio provide insight into a company's financial risk, solvency, and its ability to meet its debt obligation. Some common leverage ratio is include debt to equity ratio, debt ratio, and interest coverage ratio. Okay, this ratio is help investor, creditor, and analysts evaluate to company financial risk, solvency, and its ability to handle debt obligation. Okay, it is important to consider leverage ratio to conjunction with other financial metrics and industries benchmark to gain and comprehensive understanding of a company leverage position and financial health. Okay, we can see at the graph the leverage ratio operation between Power Root and Spritzer. Okay, for the year 2021, 2020, and 2019. Okay, for the debt ratio, we can see here for Power Root, the ratio is decreased from 2019 to 2021. Okay, 2021, the ratio for Power Root is 23.72%, and for Spritzer, the debt ratio is increased. Okay, from 2019 to 2021, the debt ratio is increased from 19.76% to 17.006%. Okay, for debt equity ratio, Power Root ratio, debt equity ratio on 2019 is highest. The ratio is 51.54, but the ratio also decreased in 2021. And for Spritzer, the ratio also increased from 2019 to 2021. Okay. Okay, you can see here the debt ratio is highest because our ratio is more than 1. Okay, the most higher ratio means the financial debt ratio for the company is risky. It's more risky. And when the debt equity ratio higher for company, the debt equity higher, it should be benefit for the company. Okay, that's all for my presentation.
Hi, my name is Muhammad Haikal bin Muhammad Fauzi Romanus, and I will explain the average collection period ratio in simple terms. The average collection period ratio, also known as the day sale outstanding ratio, measure how long it takes for a company to collect the money is on by customer. It tells us how quickly or slowly the company gets paid. To calculate this ratio, we divide the total sale revenue by the number of days in the period we are looking at. This gives us the average number of days it takes for a company to collect its payments. A lower ratio means the company collects its money faster, which is good for cash flow. On the other hand, a higher ratio suggests that company takes longer to collect payment, which can cause cash problem. Now we look at some important information about average collection period ratio of 5 well-known companies. This ratio helps us understand how quickly these companies collect the money they are on. Let's start with Spritzer. In 2019, Spritzer had an average collection period ratio of 0.62. This means it took them around 0.62 days to collect payment. The ratio improved a bit in 2020 to 0.61, but increased in 2021 to 0.77, suggesting it took longer to collect payments. Now, let's talk about Power Road. In 2019, their ratio was 0.85, which increased to 1.09 in 2020, but decreased to 0.98 in 2021. This shows they improved their collection process. Moving to Hapseng. In 2019, their ratio was 1.36, which slightly decreased to 1.41 in 2020 and further improved to 1.32 in 2021. That means they managed to collect payment within a responsibility time. Now let's look at FNN. In 2019, their inventory turnover ratio was 2.27, meaning they sold and replaced their inventory around 2.27 times. The ratio remains stable at 2.26 in 2020 and slightly increased to 2.37 in 2021. Lastly, we have Dutch Lady. In 2019, their ratio was 1.89, which increased to 2.34 in 2020 and further rose to 2.51 in 2021. This indicated they face challenge in collection payment. In summary, the average collection period ratio tells us how effectively companies collect their payments. A lower ratio means faster collection, while a higher ratio suggests delay. It's important for companies to monitor and improve their collection process to maintain a healthy finance position. What is inventory turnover? Inventory turnover is a financial ratio that measures how well a company handles its inventory. It shows how quickly the company sells and replaces its inventory within a certain time frame. The inventory turnover ratio is important for assessing how effectively a company manages its inventory and use its viable funds. It helps identify any problem such as having too much inventory or running out of stock. This information is valuable for making smart decisions about inventory level and sales strategies. Now, I will explain about inventory turnover data of 5 companies. This ratio helps us understand how effectively a company manages its inventory. Let's start with Spritzer. In 2019, Spritzer had a ratio of 1.02, which means they sold and replaced their inventory about 1.02 times in a year. The ratio stayed similar in 2020, but in 2021, it increased to 1.34, indicating faster turnover. Moving on to Power Road. In 2019, they had a ratio of 3.15, showing they turned over their inventory about 3.15 times. It improved in 2020 to 4.65 and remained high and remained at 4.06 in 2021, indicating efficient inventory management. Next is Hapseng. In 2019, their ratio was 3.61, which slightly increased to 3.83 in 2020 and stayed stable at 3.73 in 2021, showing consistent inventory management. In 2019, FNN had a ratio of 2.27. This means they sold their inventory about 2.27 times that year. The ratio stayed similar in 2020 at 2.26 and slightly increased to 2.37 in 2021. Lastly, Dutch Lady had a ratio of 5.28 in 2019, indicating a higher turnover increase to 6.48 in 2020 and further rose to 8.39 in 2021, showing significant improvement in inventory management. Higher ratio generally means effective inventory management, while lower ratio might suggest slower turnover or excess stock. The ideal ratio varies across industry. Efficient inventory management help maintain optimal stock level, reduce costs, and slightly customer demand. In conclusion, the inventory turnover ratio gives us insight into how well company manage their inventory. By analyzing the ratio, company can improve their inventory management, cash flow, and overall efficiency.
Hi, Assalamualaikum. My name is Nur Fazira binti Abdul Aziz, and I'm going to present the conclusion of this financial ratio. As a conclusion, we can conclude that financial ratios are crucial for businesses as they offer valuable insight into the company's financial performance, health, and efficiency. They help evaluate performances, assess financial stability, and support decision making. Financial ratio also enable benchmarking against industry standards and competitors, identify trends, and provide early warning signals for potential issues. Investors and creditors rely on this ratio to gauge the company's financial strength. Additionally, financial ratio aid in optimizing operations, setting targets, and improving overall financial management. Overall, financial ratios are vital tools for business to understand their financial positions, make informed decisions, and drive success. Thank you. Let's continue with the graph at the side of the slide. We can see the difference between 3 years. Doesn't much different from the chart. It is still maintaining, increasing, and decreasing. But from the Dutch Lady Company, we can clearly see that from 2021, it gained more gross profit ratio from 2020 and 2019. For gross profit ratio, it is calculated by providing gross profit by revenue and multiplying by 100. The gross profit margin indicates the percentage of revenue that remains after deducting the cost of goods sold. A higher gross profit margin indicates better cost management and pricing power.